So our penultimate panel today is all about income, what a lot of your clients and investors really want, actually. We have four excellent panellists. Ajay Dayal, who's from Legg Mason Global Asset Management. Thomas Moore, Aberdeen Standard Investments, as I say, a regular on the Today programme, so a man of superior intellect and vast taste. Colin Morton from Franklin Templeton. And Justin Onakwesi from from Legal and General Investment Management. Justin, we met at the last RSMR event in London. Now the question is income. Everybody's been after it for a while, but things are starting to change a bit, aren't they? Interest rates are starting to rise. I'll just run down the panel now and get your thoughts about where investors should be looking for income, given interest rates, particularly in the US, are starting to go up. AJ.
So, interest rates are rising in different parts of the world, but at a very tepid rate. If you look at it in the US, it's gone up a gentle amount. It's coming up in the UK, but we're not seeing interest rate rises across the world. So the first thing is selectivity. If you've got global equity exposure or global exposure, generally speaking, you can invest in different parts of the world to capture still attractive returns which are not affected by interest rate rises. But even in markets that are growing, have rising interest rates, it doesn't always mean a reduction in returns. Some companies can price off rising interest rates. So if you look at, for example, the utility businesses in certain parts of the world, including the US, they work off a regulated asset base. As interest rates rise, they can actually price up what they need to do, and they can actually pass on some of those costs.
Particularly in what you specialise in, infrastructure investments, that's the regulated model, isn't it?
Exactly. So in some of the areas, you can actually pass off some of those rises in interest rate costs, those costs of higher leverage, back to the consumer. So as a spread for a business, it doesn't actually affect you that much. There may be a slight lag effect whilst you go back to the regulator, cap in hand, to ask for more money. But in some parts of the world, you don't even have to do that. It's an automatic pass-through, as they call it, which means you can actually charge up. So it depends on regimes, that's one aspect. And actually rising interest rates, if you take a step back, the other way to look at it is, why are those interest rates rising? Does it show growth of an economy? And if that's the case, then hopefully that shows the rising earnings of companies, and then hopefully you can access that through a different route.
So nothing to fear from rising interest rates?
Well, fast rising interest rates can be severe for certain companies, but gently rising interest rates, if companies can price up, and actually that can be a good thing, like rising inflation in a kind of gradual approach, that's not always a bad thing. It allows companies to effectively price their products differently and possibly even make higher margins.
Thomas?
Yeah, it makes a nice change actually, talking about rising interest rates. I've been running my OIC for 9 years now, and over that period, I can't remember how many times I've been asked how worried I was not to own bond proxies. Well, I think the boot's on the other foot now. I think it's changing, and I think actually having an index-agnostic approach and actually saying we're going to buy companies we like across the UK market, regardless of whether they're mega-cap bond proxy stocks or small-cap stocks with gearing into an improving economy. I think that's the approach to take, and I think actually it's been an easy ride for many funds that have been orientated towards stocks that have benefited and have a very high R-squared correlation with bond yields. And of course that it's very hard to argue, I think, logically that relationship works in one direction but not the other. So I think actually now's the time to be open-minded about where you go. And of course a lot of these stocks that are bond proxies are on the richest valuations in absolute terms and also relative to the wider UK stock market that they've ever been on. So actually I would argue, although they're perceived to be low-risk stocks, you only have to look at the share price of something like Provident Financial in the summer to see, what can happen to stocks that are perceived to be low risk, and often those are the stocks that have been beneficiaries of low interest rates. So I'd actually say, look, let's flip the idea of risk around on its head and say, stocks that are perceived to be low risk, maybe they're not low risks, particularly when valuations are as high as they are. And I think, as AJ was saying, look, higher interest rates, gently higher interest rates is fine, and it reflects an improving economy. And that's true in the US, so we've got exposure through things like Tyman, which is a building materials products manufacturer, which is available on 11 times earnings. And I know not many of you will probably use direct stocks, but have a look at the valuation on that stock with sort of mid-teens earnings and dividend growth. And look, there are lots of stocks like that we're benefiting from that will continue to grow in the years ahead.
Thomas, was part of that, you talk about the bond proxy stocks, was part of their being bid up and perhaps overvalued a pursuit of income? Was that part of the story?
I think that there was certainly the element of, look, people didn't see the turn happening. So actually, even until recently, if you look at how fast something like the US bank sector has turned, you know, that was the inverse. So there were people who were obviously long consumer staples, short US banks. And then quickly that flips around. And it's actually just that, you know, when it happens, it doesn't happen over a 5-year period. This can happen in a quarter. So, you know, actually just let's make sure that we're not too over-allocated towards one particular style, in this case bond proxies.
Colin, could you just go back to the original question around where people should be looking for income at the moment?
Well, I'm going to be very biased towards this because I've been involved in the UK market for over 30 years now and running UK equity income for over 20 years. And, you know, I don't think you need to look very much further than UK equities, to be perfectly honest. I mean, they've done a phenomenal job in terms of total return, including dividends, for almost any length of time you want to go back. And I mean, a massive believer in that sort of old phrase of the eighth wonder of the world being compounding. You know, since I've been running the fund, which is 20 odd years, and you look at what's happened in that 20 odd years, you've had things like, you know, the terrible events of September the 11th, you've had Russian financial crises, you've obviously had the financial crisis, you've had Iraq wars, anything you can think of in the last 20 odd years, and we've over that period managed to do 9.5% compound annual growth rate. So simple thing like putting £10,000 21, 22 years ago is now worth £85,000 with income reinvested. So I'm a massive believer in that. And, you know, the interest rates argument at the moment, I don't really think it's... my own view is not an issue at the moment. I agree with a lot of the comments made earlier, which is it's about the speed and where we end up eventually. And the great news is for equity investors, I think the equity market has been incredibly sensible. I don't usually say that, but we haven't gone to the degrees that we might have gone to. So it's very difficult to argue that there's that many stocks in the market really believe that interest rates in the UK, 10-year bond yields at 1%, were going to be there forever. If we'd have believed that, some of these stocks should have gone substantially higher. A lot of these stocks still thought to themselves, look, we know that the bond market's false at the moment, we know it's being driven by artificial reasons, and we're not going to price our equities off that. So provided you believe rates are going to go up slowly and steadily, and the 10-year bond yield may eventually head up towards a couple of % over the next few years, I think that remains pretty supportive for equities.
So do you think actually on some measures, as we were talking about earlier, the UK market compared to its international rivals is quite cheap?
Well, you've got to look at it. I don't think you look at things like that, to be honest with you. You've got to look at individual sectors and areas. You've got to compare that more than anything else. I mean, I can understand why some UK domestic stocks have been under pressure. I mean, we've obviously had something in the UK that a lot of other countries haven't had. We've got inflation running at 3%. We've had a massive devaluation of sterling. And given the nature of our economy, if you're an importer, obviously that's put a lot of pressure on you at the same time that the people you're selling to also are under pressure. Our international stocks have done as well as other people's international stocks. Our growth stocks have done as well as other countries' growth stocks. So it isn't really much more about the country, it's much more about the makeup of the country and which stocks actually drive the index.
And if I could just a bit of a side issue actually, if I could comment, when is too much income too much, if you see what I mean? When do you get worried about a company that starts yielding 7, 8, 9%?
Well, again, this is the old problem. I like to get worried before they start yielding 7 or 8%. Yeah. This is the problem.
But do you have a cut-off point?
Well, not really. It depends what you think's in the market. I remember vividly last year, January, February, when everyone was incredibly negative on the oil stocks, when they were already yielding 9 and 10%. Yeah, yes. And I remember saying to people I'm saying to people, look, these stocks are already pricing in 50, 60% declines in the yields anyway. I want you to tell me when, you know, the example was given of Provident Financial before. That's the sort of what I want to find out, something that no one is expecting to happen, that isn't priced in. When things are already yielding significantly above the market, of course you've got to look at it and do the work on it, but quite often that means that the market is already reflecting the potential bad news. And as we've seen with the oil stocks as an example, you know, what's ended up happening is the oil price has more than doubled. BP and Shell have done an incredible job of taking cost out of the business, much more than people thought that they would be able to do. And as a result, those dividends haven't been cut. We then had the Brexit vote, which obviously helped because they make their dividends overseas. And someone like Shell, the biggest company in the UK market, has now doubled in share price terms in the last 18 months.
When that happens, do you stick around for the capital accumulation anyway?
Yeah, I stick around for both. I mean, very much I'm on it. Even though it's an income fund I'm running, I'm really looking for that total return when I'm managing money.
Justin, sorry, back to the to the original question. Where do you look for income?
I thought you were going to come to me then. I suppose it's just looking at the interest rate argument first, and maybe controversial, but actually maybe not so controversial, listening to what everybody said. Our view structurally is that rates are going to remain lower for longer. So this doesn't mean that rates aren't going to go up, right? We do think rates are gradually going to go up, but structurally we do not think that rates are going to get to normalisation before the next recession. And I think that has to change the whole psyche of the way that you invest.
When is the next recession?
Sorry?
When is the next recession?
We'll come on to that later on. So structurally, we don't think rates are going to reach normalisation. Secondly, I think that central banks, they're going to find it very easy to flip back to an easing bias. So any kind of blip in growth, any kind of blip in inflation, they're going to flip back to an easing bias, and rates are going to go up a lot, even slower than they are today. So you saw in 2015, the Federal Reserve did that in relation to China. You saw after Brexit, the Bank of England stepped in straight away and flipped an easing bias after prepping the market for raising rates for 2 years. And the first shock that comes along, they cut rates straight away. I think last but not least, I think we're in an environment we're still in an environment of financial repression. So essentially what's happened is governments have stepped in, taken private debt off private balance sheets and put it on their own balance sheet. So the last thing that governments want to do is actually have a higher interest rate burden on that overall debt. So I think those three things mean that structurally we think rates are in a lower for longer environment. And I say that changes the whole psyche, I think, of the way you invest. In terms of where we see value in the market on the income side, I think there's a few areas. So we think emerging market hard currency debt still looks reasonably attractive in a very, I would call, expensive looking fixed income market. There's one area from a relative perspective which looks cheap relative to other bonds. Emerging market hard currency debt still yielding over 5%. Pretty low overall default risk. Hard currency debt here, not local currency debt, where you get the currency volatility. The second area, one area that we've looked at more recently, is European utilities, where the valuation case is pretty strong, under-owned by the market, still yielding again above 5%. One of the bond proxies actually, which doesn't look really expensive overall. And last but not least, and still reasonably high yielding, is US energy stocks. We do think that the dislocation between the oil price and US energy stocks is pretty much at extremes. The oil price has moved, as we've already mentioned, but the equity price hasn't moved as much as you would expect in relation to that. So we do think that is another area of value overall.
Just on that lower for longer thesis, how long? How are you talking about? Because even the sort of the most hawkish people are still talking about maybe in the UK 2 rate rises over the next couple of years. That's not exactly racing ahead with inflation, with the interest rate rises, is it? So you think it might be even slower than that?
No, I think. So if there are two rate rises in the next 2 years or the next 3 years, I think it's very unlikely we're going to avoid a recession in the next kind of 3 to 4 years. So overall, we simply just don't think that you're going to get to normalisation before that next recession. And if you think that the typical probability of recession is 1 out of 6 every year, I think we've come a long way without having a proper recession.
So you think we could actually be heading into a situation where central banks are easing again before they've got back to what would be considered a normal interest rate regime?
Exactly.
Yeah.
Spot on. Yeah.
Very good. What about pension freedoms? Because a lot of people in this room will be very interested in pension freedoms. Have you noticed in your funds that people now are much more incentivised and much keener on income, given that they have a sort of a duty for themselves to invest for income, given it's their retirement savings? AJ, is this a thing that you've come across?
Yeah, I suppose when we speak to our financial advisors and the clients that we talk to, there's been a growing interest just in income. And part of it comes from what Justin was saying, the whole financial repression, low interest rate environment being for so low for so long, that people are desperately seeking income. And you can take 0.5% from a bank account, 1%. Bond yields are low, annuities are low. So even if you could buy the annuity and you wanted to buy annuity, you weren't going to get paid very much for it. But what we found post the pension freedoms has been that we've seen even more requests coming through saying, what other novel ways can you find income? We know about global equity, we know about income from bonds, we know about income from different segments, but what other novel ways? And, infrastructure has become more and more interesting for that reason, because it's a steady, predictable cash flow type of business. It's still as dishwater at times, right? But it's incredibly predictable.
Is the income still there, given that the really high prices that the top infrastructure assets have changed hands for recently? Some of the world's big airports are going for phenomenal multiples of earnings. Is the income still there? Can you possibly support that kind of valuation and still derive income from it?
Yeah, and I think this is an absolutely appropriate question. Not all assets are well valued. Some of the unlisted securities, like City Airport, went at 32 times
Yes.
PE.
Oh, that's what I was thinking, yeah.
A Canadian pension scheme bought it, and it was incredibly valued. It was like a multiple over what anybody else had paid for an airport around the world. And so, not all assets are good value. And Tom made a mention of the fact that some of the bond proxies, and sometimes infrastructure utilities are considered bond proxies. There's an element of truth for some utility businesses which can't price differently with rising interest rates, absolutely. But with the utility business and infrastructure businesses which can raise their prices, which have pricing power, they can. So if you think about a toll road business, right, these are businesses which generally have a price inflator built in. So each and every year, they can usually increase their prices in line with inflation. We own a Indonesian toll road business. It's able to effectively, every 2 years, increase its prices to the aggregate of inflation over the last 2 years prior to that. We own Alitalia, which is an Italian toll road business, which has huge amounts of toll roads in northern Italy and also in Spain. Has done a major bid for Abertis, which is the second largest operator of toll roads. Why do businesses go into it? Because once you've built the toll road, you generally get 30, 40, 50-year contracts where you can price into inflation.
Given that the best assets are going up in value, and it's going to be hard to derive the income from them, are you happy to take a bit more risk, perhaps extend the definition of infrastructure a bit wider in order to chase that return? Well,
no. So going back to your original question, selectivity is a key point. You don't want to buy all the assets out there. There are certain highly priced assets. The beauty of, to a certain extent, I come from a listed infrastructure world. I'm buying securities, and my managers are buying securities of companies around the world on stock exchanges, listed stock exchanges. So they're buying companies that you all know of. But these are pure, to a certain extent, infrastructure businesses. The other way to do it is to buy unlisted assets, where you are buying a chunk or a part of a bridge or a toll road system, etc.
Or the debt?
Sorry?
Do you buy the debt as well?
We don't buy the debt. There's nothing wrong with the debt, but it's quite often long-term and less liquid, depending on the asset type. But if that's the case, you are trying to chase enormous, very few assets with enormous pools. So, for example, the private equity world today has roughly $150 billion of dry powder, right? They're waiting. It's capital on call. They're waiting to invest for the next asset to go on the market. So when the next toll road goes on the market, when the next bridge goes on the market, they're going to bid for it. Why? Because they want that 30, 40, 50-year security. There's nothing wrong with that asset. However, if you bid up the price, you're already diminishing your return stream.
You're destroying the income straight away.
Right. So you've got to take a trade-off. And by being in the listed market, the market is a discounting factor, right? It can be quite brutal at times, but it can also reflect longer term when market pricing is going up. If that's becoming expensive, you can buy into something else. So give me a case example. Last year when Donald Trump got elected in November, lots of infrastructure companies did badly, but the toll roads in the US and the railroads did incredibly well. Why? Because economic growth and the tax the reductions that were expected were supposed to feed into these railroad companies. So whilst the market was buying up and pumping up the premium for toll roads, we were selling out of our positions and reducing them. And hence the nimbleness of kind of listed equities. You find value where others are not seeking it.
And come back again when Thomas, could you say a bit more about what you were talking about earlier about this sort of this flip you're talking about from what have been very highly stocked consumer staples at record highs into other things? Do you think we are? I mean, I haven't seen any sign of it. The Dow Jones is still at a record high yesterday. I haven't seen any sign of your idea coming true yet.
Look, I think it's slowly happening. I think what we're seeing, going back to the original question as well, and I'll link in this sort of shift in sentiment. There's this democratization of wealth at the moment that we're seeing, which is many of you, your clients, are having to look after their wealth, and use your advice, and that's a huge responsibility, and it's also a huge responsibility on us too. So those of us who are entrusted to manage that money. So we have to, I'm answerable, and I'm the whites of my eyes. I'm looking at delivering, year in, year out. And if I fail to do that, I feel that responsibility. So look, I think the thing we can do, Dominic's question on the sentiment shift here, is actually let's be really careful about what risks we're talking about. Now, I think perceptions of risk can be very different from actual risk. And what I mean by that is valuations play a role in every decision we take. So we just heard the example of that toll road and selling an asset on a very high rating and switching into something on a less high rating with similarly strong prospects. I think one of the things that's got lost, Dominic, in the last 5 to 10 years has been this idea, perpetuated by many high-profile people actually out there in our industry, that it doesn't matter what valuation you pay, because over the long run, this company's going to deliver and it'll all be okay. Look, it does matter what valuation you pay. It will be a key determinant of what returns you generate. So as somebody who's a steward of your client's capital in some cases, I want to make sure that I'm actually being responsible about what valuations I pay, and that includes listed equities. So obviously, Age has talked about some of the unlisted stuff. Funnily enough, one of the stocks that's just come into my top 10 is John Lang Group, because there's a sentiment impact. You go back to the actual fundamentals of what John Lang does and how it's evolved from being a UK specialist in infrastructure into a global specialist with 90% of its flow coming from overseas. And actually, all this noise coming out of the Labour Party at the conference about nationalising PPP assets, it's just noise, because in reality, a lot of them will roll off and expire before they can do anything. It will be hugely costly for a government that's already got 90% debt to GDP. And in the meantime, they're successfully making that transition out of the UK overseas. And the stock's on a 15% discount to NAV, generating a high teens TSR. I'm going to lap that up, and I'm going to make sure that clients benefit from that kind of total return that can generate for us.
Justin, your view on that idea of valuation and this sort of tipping point away from consumer staples or the fashionable stocks over the last few years?
No, I just want to touch a little bit on the previous question. I'll link that back to that one. So from an advisor perspective, we've seen clearly demand has been huge in terms of pension freedoms. More recently, you've had huge amount of DB to DC transfers. The FT was quoting 50 billion since April 2015. I actually think it's been more. And the flows that you've seen into the IA sector kind of tell you that the greatest year on record. And so you are seeing. When you speak to advisors, they are embracing sort of income from from a diversified source now. So essentially, what you've had over the past kind of 10 to 15 years is the emergence of alternative asset classes, different asset classes which simply weren't investable 10 to 15 years ago. And I do think investors now, advisors, are embracing different strands of income sources, and I think that's quite important.
But what expectations do you think that people whose money it is actually have of you? Because you talk about alternative asset classes. Do they really understand what you're doing, and will they be comfortable when they know that you're investing in something that's not actually BP, Shell, or Rio Tinto?
So I think, well, probably from an investment perspective, if you're spreading your risk over different asset classes, if you're not putting all your eggs in one basket, for example, I think people understand that diversification and spreading your risk over different asset classes is quite important. And actually, when you think about the stability of income over time, that diversification becomes vitally important. When advisors are doing risk profiles, etc., it becomes even more important. Coming back to the valuation point, I do think valuations are vitally important. the question you asked on the previous panel was, are we all becoming more short-term investors? And I think ultimately, as when you give advice to your clients, it's the long-term investments, we're looking at long-term outcomes. And I think over the long term, over the medium term, valuations do matter. Valuations do matter. Over the short term, they may not, but actually, if you go back in investment history, tilting your portfolio towards cheaper asset classes over the longer term, over the medium term, will benefit clients overall. And in our multi-asset funds, we try to take a medium-term view and tilt the portfolio towards pockets of value.
Just to add, sometimes you don't even have to wait that long for a reversion.
Exactly.
So, for example, utilities were one of the worst sectors in the market in November 2016 when Donald Trump got elected. What's been one of the best sectors this year in the US? Utilities. Even though technology is riding and 50% of the earnings growth of the US has come from those tech businesses, utilities is one of the top 3 sectors in the market. Why is that? Because when people look back at what these companies deliver, right, and how solid their predictability of cash flows are in a world which is relatively unstable and unpredictable at times, these things have value. And at a certain point in time, those become attractive from a price perspective.
Colin, can I just get your view on that valuation question and Thomas's idea of these highly valued stocks finally coming back down?
I'm somewhere in between, to be perfectly honest with you. I mean, the interesting thing is, I don't want to disagree too vehemently, but the reality is actually the longer you go on, the less the valuation is important.
Because it becomes...
Because of the compounding effect
exactly.
yet again. So again, if you look at, at the example I gave, if you look at equity returns over 25, 30 years, the actual expansion of the PE is pretty irrelevant. So whether the market's on 12 times or 20 times or a stock's on 13 or 20,
because it all gets washed away.
It all gets washed away. And if that company keeps producing 7, 8, 9% per annum for 20, 25 years, whether you actually paid 15 times for it or 20 times for it, actually, if you look at the grand scheme of things, it's 0.2 difference or something between your compound return. So I think one of the lessons...
That iron law of mathematics is lost on...
Well, it's a fantastic law. And I mean, the one thing I was taught really early on when I used to work at a stockbroking company in Newcastle was if you are going to pay a bit too much for stocks and you are maybe comfortable with, make sure it's quality that you are buying. So in other words, that make sure it's a company that you genuinely believe in its products, you genuinely believe in its ability to compound, because yes, you may pay a little bit more than you would love to pay for it. I mean, everyone would love to buy Diageo on 10 times earnings yielding 6%, and if it was, we'd all be buying it. Surprisingly enough, in a world where interest rates are at 1% and 10-year bond yields are at 1.3, you can't buy Unilever on that valuation. Or Diageo. But if that company keeps doing what it's done for the last 10, 15, 20, 25, 30 years, you will eventually be compound out of that. That's not to say that you can have very painful short-term periods, and we've been there many times in the past.
And it also is an explanation as to why people like Warren Buffett and the boys from Brazil are happy to buy something like SAB Miller, being valued at 28 times earning. Well, they see that they'll be holding it for 20 years.
And this is where the difficulty in this industry, I mean, whether we like it or not, we haven't got that length of time for clients. You know, it's no good me overpaying for every stock and saying to clients, don't worry, you'll be fine in 30 years' time. First of all, hopefully I won't be doing this in 30 years' time. And secondly, I'm sure they don't want to wait 30 years. But it is that difficulty. To me, when I run the income fund, it's getting that blend between trying to pay for businesses where you've got much more question mark above that ability to compound. You don't want to pay anywhere near the multiple.
It's a very difficult thing to judge, though, isn't it?
Well, of course it is, but that's what obviously we try and do, and albeit that's what we're paid to try and achieve. And if you look at the last 10 or 15 years, I mean, one of the things I quite often do with a new idea, one of the very first things I do is look at a 20 or 30-year chart of the share price. And what I try to do is I try and look to see, has that business actually, what type of company does that chart tell me it is? And quite often, so I mean, I own things like Legal & General at the moment, which looks really interesting. It yields 5.5%, et cetera, et cetera. But basically, I then do a long-term chart of Legal & General, and I realise I've got to be quite a clever buyer of Legal & General, because Legal & General's chart is like that. Then I look at a Diageo or a British American Tobacco or a Unilever, and I don't have to be as clever. You know, the longer term of those charts is pretty convincing. So it's not a be-all and end-all, but quite often these ideas I get from people, I'll go and have a look and say, Yeah, but actually, how many times have I had to have, in the last 20 years, there's been 5 times to buy that stock
Yes.
and 5 times to sell that
Yes,
stock?
and am I at that point?
Am I at that point? And with businesses like that, you've got to make sure that the valuation is very compelling when you buy those type of companies, because you've got to accept the fact that that company there will be the right time not to be in those type of businesses.
Thomas.
Dominic, can I add something? I think there's a lot of truth being spoken today, but I think that there's one thing that we need to make absolutely clear here, which is let's be ambitious. Let's actually look for companies that are compounders that aren't rated as compounders.
That's the best thing.
So if we can get some compound earnings
Yeah.
and a re-rating, we're winners, right?
Yeah.
So let's try to create a fund that actually, you know, is selective, as Adrian was saying. Let's attempt to do that year in, year out, and go for both. Now the caveat as well with the compound argument that is being made, and I often read, you know, in the press, Colgate, Palmolive, Coca-Cola, brilliant, well done. Choose the example selectively, because, of course, for every one of those winners, there's a Provident Financial or a Pearson who were, you know, actually that example, that was interesting, that Diageo example, because I was just sort of replaying that comment about, you know, we'd all love to buy Diageo on this. Could have said that about Provident Financial pre-June. Could have said that about Pearson pre the summer. And look where they are now. So actually, you know, it sounds a great theory, buying expensive stocks that compound, but hold on, are they Diageo? And is Diageo always going to be Diageo? So let's just be careful.
And I do agree. That's and that's the difficulty.
Yeah.
That, again, it's not that easy just to buy these stocks. You've got to be absolutely convinced. We're all talking about Provident Financial because it's been a very popular one. Obviously, we don't own it, or we wouldn't be talking about it. So you can tell that no one on this stage owns Provident Financial.
Shall I ask about Pearson?
Well, I have owned Pearson historically, but I haven't owned Pearson for about 4 or 5 years because, again, it's one of those companies that you start to get genuinely concerned that wasn't this compounder, wasn't doing what you thought they were able to do. And again, to be honest, Pearson, again, we can have a huge debate about it, but the management of Pearson probably didn't do a particularly good job changing from a print business to an online business, where someone like Reed or Relics has done a significantly better job.
Yeah. And listen, we heard about disruption in the last panel. We're going to try a disruption of our own and take a couple of questions from the floor. We have some microphones? If you'd wait for the microphone to get to you, do I have a hand up, or are you all in that afternoon coma? You are. No one brave enough to stick their hand up? Very good. Well, actually, we are running. Oh, we have a question. Good Lord, good man.
Thanks, Graham.
It's Graham. Wait for the microphone, Graham.
What do you think is a sustainable level of income an investor should budget for when they're planning with their pension? So they may have an idea what sort of long-term pot they're going to have, but what sort of an amount do you think they should say, right, I can take out of this every year without undue risk to capital over the medium term?
Colin?
Well, I mean, again, it's that I can't answer the overall question of looking at the overall package because I don't do that. I do the UK equity income element of it. I mean, I think, again, I didn't answer the question before about the pension freedoms, but obviously, I mean, we are seeing as well a number of more investors starting to look at UK equity income because obviously what it provides and has historically provided is a pretty attractive level of income. I mean, my fund's currently yielding somewhere over 4% against the market yielding about 3.6, 3.7. You know, I think that's sustainable, so I think I'm able to get that 4% yield at the moment and grow it a little bit, and that compares incredibly favourably to what you're getting from annuity rates, etc. But of course, the good news is you've still got your capital. So you're getting that dividend and hopefully that dividend growth, and you've still got your capital intact. The big education thing that we've all got to do, and it's much more you than it is me, is to explain to clients that stock markets move around all the time, because these are people who traditionally would have gone down an annuity route where they were happy to hand the money to somebody and just get 4 or 5% a year paid monthly into their bank account. You've got to get people to think the same about buying equity income product. Don't worry so much about the capital value from month to month or quarter to quarter. Just make sure you get those dividends and you get the growth in those dividends. So, I'd say I'm yielding just over 4 at the moment, and I'm pretty confident that we can sustain that level and grow that dividend over time.
I think, and added to that, look, if you have an income objective, your client has an income objective, then you obviously need to build a portfolio that's attuned to that. If you're going to buy an emerging markets equity fund with a 1% yield, that's not going to get you there. If you look at the last 10 years, and you look at where, effectively UK 10-year bonds have gone from 5 to 1%, just over 1. And then you look at the MSCI World as a global equity proxy, and it's gone from anything between 2 to 3.5% and back again. But if you look at a subset, so, I work for kind of like Mason, and we have an affiliate called Rare Infrastructure. And if you look at, they have an approved list of 200 infrastructure companies from around the world, global listed stocks, which they monitor, and that's how they build their portfolios. They build 40, 50 stock portfolios from this list of 200 companies. If you monitor that 200 companies over the last 11 years, their level of dividend has stayed between 4 and 5% throughout that whole period. Why? Because if you're going to deliver income, you need companies to grow at least at that rate and have dividends per share growth that can compensate. So buying companies that can actually grow their dividends long term in a consistent, predictable manner is helpful if income is an outcome that you're actually trying to achieve. So for certain types of portfolios, it is more sustainable than others.
Just one
Very,
last point.
very quickly. Just
I'll be very, very quick. So I simply don't think there actually is a magic formula. I think that the conversations that I'm starting to have with advisors is that actually obviously every client's different, but also that market conditions change, but also their overall situation changes, right? So let's say an 80-year-old, if if healthcare costs jump up, then obviously then their number is very different from if they didn't have that situation. I do think that advisors are moving more towards dynamic withdrawal strategies, where they're sitting down with their clients every so often and then revisiting what their overall objective is. So I think that the overall magic number, so to speak, is linked back to the client's attitude to risk and linked back to what the client wants from that accumulation phase.
Thank you very much. A really, really, really interesting panel. Thanks very much for our panelists. Justin Onakwesi from Legal and General Investment Management, Colin Morton from Franklin Templeton, Thomas Moore from Aberdeen Standard, and AJ Dayal from Legg Mason. Thank you all very much.
Thanks,